analysis on putting together a put trade on Nike. As you can see, I'll have to explain a few things. This blue line is the date that I entered the trade, which is May 9th. The black line here is the day that I actually exited the trade, and this line here is the expiration date, which is the amount of time that I bought for the trade to hit my target. Now, when trading options, you need two critical elements. You need to know the time, the price target, and the time it takes to hit the target. As you can see, Nike has been in a downward trend for quite a while, and also it's confirmed by the momentum. If you connect the highs, you got lower highs. So again, I'm setting this trade up as buying puts to take advantage of the downward trend in the market. The first element I'm going to look at is the time duration, and how I estimate that is I use the prior significant highs. I use this time extension tool. I connect the highs, and then it took 22 days, so going out another 22 days, that's May 13th. So I got the time element. So let's look at how we're going to project the price target. Again, using the two significant highs, I take this zigzag tool here. I'm going to connect the two highs along with the significant low. So from high to low, back up to high. And these lines across here are potential price targets. It's already hit the 61.8%. So the next target is 200%, which is about 108. Nike closed on Friday the 6th at about 114. So between 108 and 114 is $6 move. So let's go and see if we can find a trade for Nike. Let's go to the option trade chain. Since we're playing a downward move, we're going to use puts on the right, call on the left. These yellow boxes show what strike can hit its target in the shortest amount of time. And based on Friday's data, that's the 1/16th strike price. As far as time goes, we were looking at May 13th. There is a May 13th, but I don't like going on the exact day, so I go out to the next expiration date, which is May 20th. And as you can see, that was May 20th. If I put that here and you look down the bottom, that's May 20th. So I bought a little bit extra time there. So May 20th, 1/16 strike, I put $6,000 in this trade, and I'm going to pay the ask price of $4.80, $4.80. A contract covers 100 shares, so you multiply that by 100, that's $480. So for $6,000, that 480 is 12 and a half shares. You have to round up, so that's going to be 13 shares, 13 contracts, I should say. Hit the risk graph, and we see what numbers we got here. So we have the expiration of May 20th. I bought the 1/16 puts, and I paid $4.80 for it. So that's what the chart looks, and you see that gap down low that you saw on the original. That's Friday. So let's advance here one day at a time. So this is now May 9th, my entry day. Sorry. Day 1, day 2, day 3. I'm almost at 108. So day 4, it gapped down and then retraced back up. So actually the low, if you look up there, is 105. I was expecting to get to 108. It actually gapped to 105 and then recovered some of that loss. So let's look at the risk graph and see what happens. So let's go one day, which is Monday, my entry day. I'm up 34% or $2,000 on the open. Next day, day 2, $3,000 at 56%. The next day, I'm up 75% or $4,000 day 3. And let's go day 4, which is I got out on May 12th. You see it dropped from 75% to 70%. But as I said before, there was a gap down and then the price jumped back up. So let's zoom in a little closer on that and see what I actually did. So 104, let's look at that as low. So actually, on that day, May 12th, the day that I got out, the low for Nike was actually 105. So if I go over here and to 105, let's see, that's close enough. Profit is 78.21. You know 78.21 is more than the 62.40 that I put in, so we already know it's going to be over 100%. So 78.21 divided by 62.40 is about 125%, which is what I made on this trade. So in actually 4 trading days, I was able to get out of this, and out of the 22 days, I still have 8 days left. So hopefully this explains how I analyzed this trade, put it together, and then executed it.